Hello and good evening, everyone. Really appreciate you being here in this lovely venue. We hope that we can be informative for you here tonight. I think we will be. For our agenda this evening, my colleague John Labarca and I will be discussing We'll be discussing the economic environment. There we go. The economic environment as it has manifested itself over the last year or so, where it is right now, how all of those manifestations within the U.S. economy and the global economy are translating themselves into the expressions of financial markets. Where we see areas of opportunity now and a little bit in the future, and then how we expect things to evolve throughout the course of the year and in the coming years. And then we'll have time for Q&A. So we look forward to all of that. Again, thank you so much for being here. The U.S. economy, I think people may have heard the phrase American economic exceptionalism, a phrase that's meant to describe the U.S. versus the rest of the world in terms of economic activity. 2024 embodied that more than I think any year as of late, with the United States having really strong real output growth, very strong personal consumption, very strong business investment, very stable and growing labor markets, while the rest of the world, the rest of the developed world, and including China, are flirting with recessions. So the United States was really an incredible standout, and this is all despite what we heard over the last couple of years, again going all the way back to 2022, which was widespread calls and predictions for recession. We have spoken to you all about that at various times consistently in the past. And virtually all economic and econometric models that are out there predicted that. But it obviously hasn't materialized. You can see this chart showing real GDP output, real output growth, really strong here in late 2024. Still growing at 2.3% annualized year over year. And why hasn't the recession materialized? And I think the thing that economic models and most economists underestimated was the residual impacts of the pandemic era stimulus, which again was worth 10% of nominal GDP, really a staggering number. A number that's unprecedented in history. And so clearly the positive feedback loop of that pandemic era stimulus has played a significant role in powering the consumer. And then, of course, driving business profits, causing reinvestment by businesses, therefore causing more hiring by businesses, keeping the labor market very strong and stable, and then creating additional incomes for people who now have jobs that didn't have them before, and then them starting to spend money. That's the positive economic feedback loop. So that's really this long residual effect of the pandemic era stimulus apparently, seemingly was underestimated by economic models, and that's what's continued to power the U.S. economy in a really good way. Also, the Fed was very accurate, which was an incredibly hard thing to do. They were able to keep the Fed funds rate below the growth rate of nominal gross domestic product, which is output, and they were able to stay ahead of the slowing growth rate of nominal GDP, and that's allowed them to effectively manage themselves from an inflation situation, a much higher inflation situation, to an inflation situation that's operating at a much lower level. And also, really importantly, as part of this economic picture, real wages for Americans are now positively growing again. They're positive and they're growing, which is another huge impact point. when you have GDP output like we've had, you tend to have really strong job gains. And that's what we've seen coming out of the pandemic. This is a chart showing the three-month rolling average of net jobs added by the Labor Department payroll. You can see starting up really, really high at 600,000 a month to just over 100,000 a month. Obviously, things have stabilized from where they were, but we've still had incredible strong and consistent durable job growth. And I think importantly too, the labor market is no longer inflationary. Back in 2021 and 2022, wages were growing much faster than productivity, and as a result, there was an aspect to it that was inflationary, that was helping to drive inflation. That's no longer happening as productivity and wages are basically growing at the same rate. As comes along with really strong real output growth, it's difficult to keep inflation from being biased to the upside. That's the consequence that comes with a really, really strong economy. This chart shows core personal consumption expenditures, which is the Federal Reserve's preferred gauge of inflation. This is a year-over-year chart. So we're just settling in here, just under 3%. And this is going back all the way to January of 1993. And what's obvious here in this chart is that the level that we've come down to off that very high peak is actually much higher than levels that we've operated at in previous eras, particularly eras that were rather inflationary in nature. Some of you may remember the 2005 through 2007, 2008, what we call the commodity super cycle. That was when oil hit $140 a barrel right before it collapsed, going into the great financial crisis. That was an environment in which whenever you have commodity prices that are that lifted, you're inevitably going to have upward pressure on inflation. Yet you can see where we are relative to that, and we have settled in quite a bit higher. We're not putting this chart up here to imply that we expect or anticipate inflation to revert higher. We're not even putting it up here to imply that we think that inflation may stay where it is and remain sticky at 3%. We're just simply putting it up here to say that when you have really, really strong output growth, really strong economies do power upward pressure on inflation, and that's why it's proving a little bit difficult to get it to continue to come down further. And the Fed funds rate is currently sitting at 4.3%, and nominal GDP is probably growing 5%, potentially even more. So if you were to drop the Fed funds rate any further under that kind of economic environment, it would probably prove to be overly accommodative. Productivity, something that we don't get to talk about much because it doesn't happen in a big way very often. But maybe the second most powerful force behind really strong real output growth is a phenomenon called productivity. This is essentially the output of the economy per hour worked in aggregate. This chart goes way back. If the rates of change are increasing, that means that more productivity is occurring with less amounts of units of labor hours. And the most notable one that you see has been quite some time now is back in the late 90s and early 2000s, but mainly the late 90s. Technology has a lot to say about productivity. In fact, it's the primary driver of productivity, has been for centuries. And of course, in the 90s, with the advent of the internet, with email, with really rapid advances in software and databases, you created a situation in which there was very efficient means of communication, fast access to be able to work, transfer, share information. Productivity really, really increased. And when you have productivity increases, that means two things happen right away. One, profits of businesses increase. That causes businesses to reinvest those profits. As they reinvest those profits in fixed investment, they then tend to hire more people, which fuels the positive feedback loop of economic activity. Also, it's probably the best thing you can do for real wages. When there's productivity boosts, you get positive real wage benefits, which is really, really good for American consumers. We believe that we are probably already underway in a similar type of event here in the form of generative AI. What we expect to happen is that generative AI is going to reduce costs. It's going to allow companies to really understand themselves better about the business that they're operating in, about the markets that they operate in, allow them to make more accurate and informed decisions. Some will even be able to reach larger markets, and that the benefits are going to be widespread, meaning that it's going to be widespread to virtually every industry and probably most companies. Secondarily, this very powerful force for positive real GDP growth comes with another benefit, and that benefit is that you can get the positive economic growth while providing a downward pressure on inflation as opposed to an upward pressure, which is a big deal. Okay, the election. How will the new government and new administration impact the economy and therefore the financial markets? Remember, financial markets are concerned about only the future of economic activity, not the past, not the current, but the future. So the primary impact of this new government and administration will be regulatory in nature. This will be a reduction of regulations of which they have power to do, similar to that of 2017. This will cause an increase in speed of economic activity. Some economic endeavors that wouldn't have occurred will now occur. So at the end of the day, this will be at least a marginally net positive economic impact. The secondary impact will be fiscal in nature. That will be along the lines of the tax cuts that were scheduled to sunset here this year and next will definitely be extended. There's also the potential for new tax reform that could involve cuts that are more favorable to consumers. Those two things on the margin, on the increment, are a positive net impact economically. The third impact is tariffs. This is a very complex dilemma, and it is likely to be highly variable on how it will impact the economy from industry to industry and probably even company to company, depending on the levels of competitiveness of each company within the industries that they operate. So very complex. But in an overly simplified version, you can reasonably expect that the implementation of a tariff or a duty will provide an upward pressure on prices. However, the amount of that upward pressure is probably going to be a very, very small fraction of the size of the duty itself. So if there's a 10% tariff, it's going to be the price impact to the consumer at the price level is going to be a very, very small amount of that 10%. It's not just going to be because the tariff is 10%, therefore the impact of inflation is 10% or even something like half that. It's going to be something very, very small as a portion of the level of the tariff. Additionally, we do not view tariffs as a mode of economic regime of this administration and this government. In other words, we don't view that they're looking at it as in a way of a mode of raising revenue, but rather a mode of negotiating for things that are really not economic in nature. And we've already seen a tremendous amount of evidence of that in the pausing of several tariffs that were scheduled to go into effect. want to say something about aggressiveness of tariffs, because that's another point that comes across in these conversations, is the aggressiveness in which the United States is approaching the world with these tariffs. And while it might seem that it's aggressive, specifically in the context of how it's done, it is also important to note that the United States versus its 15 largest trading partners has the lowest simple average of most favored nation tariff rates of all of them. So even if you increase the tariffs from where they are, it would still probably fall short, or at worst meet the level of the second lowest trading partner of America's 15 largest trading partners.
All right, thanks, Jeff. I'm going to transition here a little bit after that economic discussion to just go through markets, how markets have been reacting to all of the news and the developments and just the whole economy over the last year and even longer than that, get into some of our outlook and areas of the market where we're seeing opportunities. What you see here is just a little background on market performance for the last couple of years. I would say on a headline basis, it's been a really strong period for markets. The S&P 500 was up about 25% last year in 2024. And it just had its strongest two-year period since the 1990s. So that's the headlines. That's what we read about. Things are going great. If you get kind of beneath the level, it's not quite as strong as that. What we saw last year in particular is that what people call the Magnificent Seven, right? So these 7 enormous technology companies that thus far appear to be the primary beneficiaries of artificial intelligence in particular, have been performing phenomenally well. In fact, they accounted for more than half of the gains in the S&P 500 last year, only those 7 stocks. Most other companies in the index lagged the headline performance quite a bit. In fact, the average stock in the S&P 500 was only up about half as much as the index itself. You also see on the chart the small cap index, which is the lighter blue color there. And you can see how it's kind of lagged behind. It was up only 8.6% for the year, so only about a third of what the S&P did. And then the grayish green line that you see there is the international stock index. Again, lagged the S&P pretty significantly for all of 24 and 23 as well. The bond index is not shown here, but we had interest rates move up late in 24, so the bond index only ended up being up 1% for 24, so again, another disappointing year in the bond market. Bonds were a little bit better in 23, but that was kind of the only solid year we've had in that market for the last few years. So just wanted to talk more about the Magnificent Seven, what we call a concentrated market, sort of the environment we've been operating in. You may be reading about this in the news quite a bit, that concentration in the stock market is at an all-time high right now. Well, what does that mean exactly? This chart is showing the percentage of the total United States market value that is accounted for by the 10% of the largest companies, basically. What could be also called mega caps. So that's not just the 7 companies, but the 10% that are in that largest bucket of companies. And you can see here most recently that that concentration percentage has reached 75% roughly. So that means the other 90% below that, right, are only accounting for 25% of the market value. So that's at an all-time peak. We have peaked out at a similar level a few times in history. Most notably, the last time was in 2000, the peak of the dot-com bubble. That doesn't mean this is the dot-com bubble again, but it was just a period where we saw some similar dynamics. We also saw that this concentration approach these levels in the 1970s, didn't quite get up so high, but that was an era called the Nifty. There's a group of companies called the Nifty 50. It's thought of as the best group of 50 top U.S. companies that if you were a stock investor, you had to buy them and own them because they were the best companies or changing the world. Well, following that 1973 period, they went on to have a really weak period of performance for many years after that. They became somewhat overvalued at their peak. And then even below this, when I was mentioning the S&P 500 earlier, the 7 companies that I was talking about now account for 34% of the S&P 500. So we've never had an environment where so few companies have made up such a large portion like that of the index. So this chart shows what happens basically after in periods throughout history, after we've hit these peak concentration points. It's a little tricky, but stay with me if you can. What the chart is showing is basically 10-year periods of performance, and the line, what you're seeing here, when it goes up to 6% or 4%, that's the outperformance. So it's the performance of the smaller companies over the larger companies. And again, it's 10-year periods. So you see the peak here in 2010 was the best performance period for that 10 years. So that period would have started in 2000. So if starting in 2000 through 2010, you held a portfolio of the 90% of the smallest companies, you would have done 8% per year better over that 10-year period, right? So that's over 80% in returns that were better than you would have done by just holding the top 10% of biggest companies. And you can see again in the period that began in about 1973 and ended in 1983, similar dynamic. If you held the small companies for those 10 years, you would have been much better off and done even better than that. It was 9% per year over that decade, right? Where we're operating today is 2024 into 2025. We're at the lowest end of what we see here in this range, right? Just similar to what we would have experienced in 1999. This shows kind of the same dynamic a little differently. What you see here is the net performance difference between small cap stocks in the United States and large cap stocks in the United States. The red bars represent small caps where performance was lagging behind large caps, right? And so what does this show? In 7 of the last 8 years, small cap stocks in the US have underperformed the large cap stocks. The last time we saw something similar, again, the 1990s, we had 6 years in a row of a similar dynamic. And then starting in 2000, it flipped the opposite way, and we had 6 years in a row where small cap stocks outperformed. So this is, again, same topic shown a different way. This is illustrating how the companies in the 2 indexes that I'm just talking about are being valued in the market today. We've shown this chart before. For the last year, we've been showing this chart, right? This is the backdrop for different parts of the US market. The light blue line shows the price to earnings ratio, so how many, the multiple of current earnings rates that the market is paying for these large cap companies is almost 22 times right now. It's roughly at the high end of its historical range, as you see there. The greenish line is the small caps, that is 16 times earnings, and it's closer to the low end of its historical range. And you see that gap between the 2 of them, 6 points there is the difference about. That's the largest discount, we would call it, that we've seen in way over 20 years at this point. So with that as a backdrop, that's the starting point for where we are today, right? We see small cap stocks attractively valued, a long period of underperformance, very high concentration in the market from all this outperformance of the biggest companies. Well, the issue, right, why hasn't this changed? Why do we continue to see this year after year? In recent years, since the pandemic mostly, we've been in this very strange economy where strong nominal GDP growth, which Jeff was talking about, right? The US economy in aggregate has been very strong in recent years. That strength in the economy has not flowed through to corporate earnings for the vast majority of companies, which is a really unique environment we've been in. Usually the correlation between US economic growth and corporate earnings in a wide array of industries and companies is much stronger than we've seen. So you've seen a few big companies doing really well. Their stocks are doing well because their earnings are doing well. They've had phenomenal growth across their businesses. And most of the industries and companies below that just have not, right? And so some of the issues that they've been dealing with are higher inflation and interest rates. That's hurt results in a large number of industries, particularly financial companies, banks, materials companies, industrials companies. A lot of these industries are much more sensitive to interest rates and have had a harder time dealing with cost inflation and then the process of passing that through on with raised prices in their own industries. And in fact, many parts of the industrial economy, manufacturing, agricultural parts, construction, have really been experiencing recession-like conditions, even in what's been a really strong overall economy. Regulatory requirements, Jeff kind of hinted at as well, have been increasingly difficult for companies, particularly in many of those industries, to deal with, whether it's labor regulatory requirements or environmental requirements, expensive and costly to their businesses. So while we have this backdrop of an attractively valued part of the market that's underperformed, hasn't necessarily been super timely, we think that part of it is setting up nicely where we think it's becoming more timely for these stocks, a wider array of stocks to finally start showing some improved performance. So there's a number of areas that we feel like that have been problematic that are poised to at least improve in 25 and probably 26. The first of that would be construction activity. It's been a soft area of the economy, of course, with interest rates up. Residential and non-residential starts had been soft for some time. Starting to see improvement in both of those areas, at least in initial starts, particularly on the residential side where we're still dealing with shortages in many areas. So the outlook is a little bit better there, even though interest rates remain high and somewhat challenging. There's something to be said just for stable interest rates, right? They're not necessarily shockingly higher anymore. A prolonged period of them leveling off gives builders more confidence to start projects at least. Farming profit outlook is stable to improving. We went through a long period where crop prices were down or weak. At the same time, a lot of the farmer cost inputs were very inflationary. Fertilizer prices after the war in Ukraine and Russia spiked, so it's been a difficult environment, which leads to subdued activity and heavy machinery purchasing and just a lot of things that go into the industrial economy. Crop prices, many of them are up pretty significantly in recent months, and their cost backdrop for farmers has stabilized. So the environment there is also improving somewhat. Manufacturing activity, a number of metrics in the manufacturing industry are starting to pick up a little bit. A lot of surveys, a lot of activity that's measured for the first time in a long time. The last few months has showed some positive signs. The US just went through, I think it's 7 quarters in a row of negative manufacturing activity domestically. Never seen that outside of a total recession in the US before, so again, really unique. But most economists expect the first quarter now to be the first positive quarter for manufacturing activity in 2 years. The profit outlook for banks is obviously much improved from what we've been experiencing. The yield curve, which you've probably heard about, which is just the term to describe the relationship between short-term interest rates and long-term interest rates, has been somewhat inverted for the last roughly 2 years, which means that short-term interest rates have been higher than long-term interest rates. That dynamic and environment makes it impossible for banks to make money. They borrow on short term and lend longer term, and so they need a positive spread in that curve to make profits. More recently, the interest rate curve is back into positive territory, at least, so the environment for them has improved somewhat as well. Regulatory burdens, again, Jeff mentioned that one. They're starting to ease, and there's hope that they should ease more significantly. We'll have to see what happens with policies. A lot of the announcements we're seeing change day by day, but one thing seems like we will get some relief on the regulatory front, which could help many companies. There's also the potential, we don't know again yet, for slightly lower corporate taxes that's been talked about. We'll have to keep an eye on that and see if, smaller domestic companies in the US would be a primary beneficiary, though, with a lot of their business, obviously domestic happening inside the US. And then finally, just highlight again on the timeliness of the small cap sort of pocket of the market. What you see here is a survey of business confidence from business owners that is run by the National Federation of Independent Businesses. So it's showing us small business confidence, right? And what you see in that chart is the biggest surge on record in recent months from small businesses. And this talks about their outlook for general business conditions. What's really eye-opening, I thought, about this data is if you look at 2022, 2023, most of 2024, again, a time period when the economy was doing very well, the confidence from small business owners was, the worst on record, right? Recessionary levels. That confidence level is below what we even saw in the GFC in 2008 and 2009. And now we've gone from that environment to the highest level on record, basically. And so what's driving that? They expect some improvement in the inflation situation, but a lot of it is on regulations, really. So there's a quote here from the CEO of Bank of America, just from a few weeks ago. Brian Moynihan said, small business optimism has changed. You saw that, the regulations, it's hard to do business, hard to get things done. The rules coming out, they don't have big staffs that we do, that other companies do that can deal with all of that. It confuses them, it slows them down, it makes them hesitate. Their belief is that that's changed, and that's why I see the optimism come up. So this is sentiment, it's optimism. We need to stay on top of this and make sure it translates into investment, into activity. We don't know. This could change, right? But it's a positive sign for this part of the market, at least. And again, we'll have to be balanced with staying on top of everything you're reading about day to day that could disrupt things, right? As Jeff mentioned, tariffs. We can talk about all of the things that are in the news. They will all impact these things, and we don't know how they will all play out exactly. But there are positive things going on as well, right? Which we're trying to point to some of those signs in especially this part of the market. So just to summarize our outlook, we think the economy will continue its recent pace of growth. Again, the caveat there, what I just said, right? We'll have to see how a lot of these things shake out, if anything has the potential to change that. But for now, that would be our expectation, that the pro-growth parts of the policies may help, as will just the uncertainty we've had moving past the election. People sort of know, right? We have uncertainty with exactly what the policies are going to be, what's going to be in place, so that, we'll need time to get through that and sort of see how that shakes out. But we wouldn't expect a major change right now from the kind of growth that we've been seeing. As far as stocks and bonds, we expect what I would say is more average historical type returns. So what does that mean? It means we wouldn't expect stocks to do 25% a year like we just experienced for the last couple of years. We would expect closer to historical averages for stocks. But again, maybe different performance in different parts of the stock market. And bonds, we would expect more historical averages, better than we've experienced for the last 4 years for bonds, right? It's a better outlook. Interest rates are up. That's a much better starting place for our bond performance than we've had. We do expect a broadening out of stock performance. Again, a lot of what I talked about. We've recently increased our weights in smaller cap companies, lowered the weights a little bit in our large cap holdings. With elevated valuations there, we just think the attractiveness has gone down slightly over the last year. We think small caps are just poised to outperform. So that's it. I'll leave it there with our outlook, and we just would like to open it up for Q&A at this point. Okay, so for those who didn't hear, the question was about job creation and salary levels. So there was a comment that for every 10 jobs created, maybe one is lost, but what are the different salary levels of the jobs being added versus jobs being lost?
Yeah. The chart that I showed was just the net jobs added, 3-month moving average of net jobs added, which came down to right around 100,000, just a little bit less at one point earlier last year, which surprisingly is not all that dissimilar from levels that can occur in recessions. So it was remarkable in that sense, but is improved. As far as replacement rates of salaries, I don't have any hard data on that. We do know that the most reliable wage growth indicator, which mathematically takes into account of all these things in aggregate, is something called the Employment Cost Index, and it only comes out once a quarter. It came out rather recently, and it's still showing high threes, almost 4% year-over-year wage gains, which is a very strong number. That's much stronger than what we've had for decades on average. And that is expected to take into account the translation effects of jobs lost versus jobs added. The question is about when you impose a duty and of some level called most favored nation rates, and whatever it is, 10%, 20%, you've heard the numbers, on a specific product, even if it's like a finished product, for example, like a lot of the apparel retailers actually make full finished products overseas, and then when they ship it back over here, off the ship, it is a full finished product that we're putting on right as we are right now. And so the tariff would be applied to that whole finished product. And so the question is how does that manifest itself in the price that we pay ultimately for the piece of apparel? And it's complicated. The importing firm here in the United States is the one that actually pays the duty to the Department of Commerce. But it's very likely, and this depends on, again, competition as well as the pricing power of the importer, what kind of negotiations they're going to get into with their contractors, the outsourcing firms overseas that are making the product, and negotiating a lower cost to them of the product as a result of the tariff. So part of it gets split up as the producer back in China or Vietnam or wherever the product is being made, and some of it potentially is borne by a rise in price here by the actual seller of the product to us. There's secondary effects that go into competing or substitute products and their pricing activity because they become instantly more profitable by the tariff placed on a like good. So that may affect what they do with pricing. The other aspect is really important is currency appreciation of the importing country. So in this case, it's going to cause an appreciation in the U.S. dollar versus the currency of the country that has the tariff on it, and that will in turn reduce the cost paid by the importer to the contract manufacturer as well. So in a way oversimplified example, you can kind of think of as a 10% tariff if you kind of go through with a bunch of reasonable assumptions to a finished product like a piece of an apparel, that a 10% tariff would probably cause like a 0.6% increase in inflation on that product to the American consumer, I think is a better way to think about it. That is, there's no hard rule there. That's not a rule of thumb or anything like that. But if you make some reasonable assumptions, that's a reasonable way to get to the actual math of how it all works out. So again, when I say fractional size, that's a pretty small fraction of the 10%. And I think that's important because on the surface, it's always, you hear these large numbers and you think, oh my gosh, my prices are going to go up by 10% or 15% or 20%. And that's not exactly how the math works. There's a lot of moving parts in there. As I said very specifically, though, all things equal, that will provide upward pressure on inflation when you impose a duty. The question is the magnitude. I hope that helps.
For those who couldn't hear, the question was about just this slide here, and more specifically what I mean by some of the statements, particularly the second bullet where we say we anticipate average returns for stocks and bonds, and then near the end where we talk about small cap appear poised to outperform, just more specifics about what I mean by that. So I should have clarified that. When I say average, I mean close to historical averages. And so I would say for stocks, historical average returns have been high single digits per year for stocks in general. So ballpark, that's kind of the expectation. I hate to get too specific on what we think stocks are going to do in any given year, right? That's almost impossible to do. But I would say that's how we categorize kind of how we feel about things right now. So, single digits as opposed to 25 that we just did last year. And bonds, I would say, the interest rates on bonds are in the 4 to 5+% range, and that's a good starting point to think about what bond returns might look like. So I would say mid-single digit type returns on bonds from here is reasonable per year, and that's kind of in line with historical averages. It's not in line with the last 4 years, and even some of the years before COVID, interest rates got really low, and bond returns in some of those years were lower due to lower interest rates. So that's kind of ballpark what I mean by those statements. And then when we say small caps appear poised to outperform, if stocks in general, I'm saying high single digits, it would just mean that we think small caps could be even better than that. So maybe low double digits for that part of the stock market. Yeah, that's a good question as well. Again, follow up, one of the charts I put up there showed historically kind of the outperformance we've seen in the smaller companies versus the larger companies. And that chart wasn't meant to say we expect that same thing to happen now where we get 8% per year better returns for a long period from one versus the other. It was just directionally trying to show what can happen. Again, these are sort of our best guesses as to what to expect. So when we say stocks, maybe high single digits, small caps, if things work out, depending on some of the policies and the risks. When I say low single digits, that could be a few percentage points a year better. It's hard to say how many years that might persist for. So I wouldn't expect the 9% type of outperformance per year for a decade that we saw. I'm not saying that's likely to recur, but we're just trying to put in perspective how things have gone historically and areas that we're finding attractive. So I hope that helps somewhat. Yeah, that's a good question. When I say small cap, what does that mean? How small are the companies? What's the market cap? What areas of the markets might do best? Again, some of those data points we showed were kind of generalizations, and when we say small caps are poised to outperform, in some ways the environment is similar even within the S&P, that we feel there's an opportunity for some of the smaller companies even within that index to outperform. So that would be mid-cap. The small-cap index really is comprised of companies below like $3 billion of market value currently. So even small-cap companies that are public companies are sizable companies. And that's kind of what we're talking about. One thing in particular that's driven the performance of these large caps has been the artificial intelligence. And you may have read in the news recently, there was a big development a few weeks ago out of China, where this DeepSeek model came out, right? It led to some stock volatility in the US in particular. And I think the thought and some of the concerns in the market are that they potentially created something there that's similar to what we may have here, but the claims at least are that they created it for a much lower cost, right? And so there's been other recent developments that suggest that the cost for artificial intelligence are starting to come down. And we do believe they're going to come down significantly, right? And one of the benefits of that would be that a wider array of companies can benefit from that technology, right? And so that plays into what I'm talking about when we're talking about small cap companies. We do think artificial intelligence will be a big positive. we think it'll be a positive for the economy and for a lot of companies, for consumers, not just for 7 companies, right? And so the market's view has been very narrow, that in some ways expressing this view that only 7 companies are going to benefit from this technology, because that's where all of the market value is flowing thus far. And so I think that will be part of this. So anyway, it's a long way of saying I think there's various parts of the market that are attractive that we kind of covered a little bit. So hopefully that helps. There was a question about AI and what we think the impact on the job market will be.
Yeah. I think the best thing we can do in these types of scenarios is to look back in time and see how large quantum leaps in technology have followed through with the economy. And it's hard to say how incremental this is going to be. I think only history will tell us that. But gosh, I can think back and remember things that seemed to be at the time as being incredibly incremental too, in terms of quantum leaps, like the telephone, the personal computer, the internet. And in every one of those instances, we always think, well, gosh, think about how many jobs are going to be replaced. And in some cases, a lot of that's really true. Industries do get eroded. Industries that used to be big, vibrant, very profitable, whether it's because of technological advancement or whether it's just because of how the world changes, they change, and they, in some cases, end up no longer. And so in certain areas of the economy, there's always going to be the case where people, certain aspects of jobs are going to get eroded away. And my dad always used to tell me, just think about the savings and loan, all the savings and loan bankers back in the early 90s that had jobs that very quickly didn't have jobs, not too long after that. So, but what does come along with technological advancement, big quantum leaps, is that money gets invested in these new technologies, and those new technologies create new ideas. Those new ideas create new companies. Those new companies create new profit streams. Those new companies then hire more people. Those people now have paychecks. Those paychecks get funneled back into the economy in the form of personal consumption expenditures, and even that ends up flowing back to small businesses like restaurants and bars that then cause more job growth. So at the end of the day, they're always positive for the economy. They're positive for job creation. They're just not positive for all people as part of job creation, I think, is the best way to think about it.
So the question was about our expectations for the bond market, what's implied in there for what the Federal Reserve might do. And it's been a rough period for bonds, so why is our outlook a little different than we've seen underperformance for a few years? So one thing that's changed is that the market as a whole no longer has much expectation for further rate cuts from the Fed. Our view on that is not that different. We don't expect much further rate cut either. So we just think rates might be stable or near stable to where they are right now, which would be okay. If that happens, our bonds could do pretty well. We don't need interest rates to go way down to do better than we've been doing on bonds. So that's kind of the general outlook, I would say.
Yeah, the only thing I would add is just maybe to help contextualize what's already priced into the interest rate. So when you're looking at the 10-year at 4.6%, I think is today. If the Fed were to maybe decrease rates one time over a year and a half or something like that, and then slowly but surely that after 6 months later or a year later decrease another 25 basis points, and then a year later another 25 basis points, all the way down to about 3.5% on the Fed funds rate. And then if over time that kind of came totally true, then over the next 12 months, if that's what everyone still thought would be the case, 12 months from this day, the 10-year yield would still be at 4.6%. So the 4.6%, the 10-year yield already accounts for that thought process of pathway of future short-term interest rates.
Yeah, thanks. So the question is generally about risk and how are we thinking about systematic risks, which we can follow and track, and we deal with those often, versus systemic risk. For a lot of hypothetical situations that could come up, right? You talked about the administration, things like bird flu. If we don't have the CDC in place, how do we deal with something like that? I mean, these are all great questions we think about every day. We don't have a metric we track for how we think about the systemic risk part of it. We're trying to build durable portfolios that can withstand some volatility. We look at confidence across markets, currencies, interest rates, credit, all these types of things to monitor, where's the market on some of these issues that are, maybe risks that are out there. So we're thinking about them, we're trying to monitor them. There's not a metric I can point to that kind of answers that, I don't think, at the moment. Jeff, you have any thoughts on that?
Well, I would add that, like with the specific case of bird flu, and while the makeup of the public health structure, as you mentioned, has been altered, we also do still have a very strong private sector blueprint for how to go about that, and a private sector that is shown to be very, very good at dealing with a global public health viral emergency. And, there's also a lot of checks and balances within the system itself. A lot of things have to happen and get checked off one after the next in order for one entity's wishes to go through versus another. So I think there's some level of faith in that as well.
Yeah, I mean, there's a lot of risks that we don't know about, right, that are going to come up. And I think a main point is, like, we can't let all of that and the hypotheticals on how things could go keep us from investing. We're going to monitor them and do our best to work with the environment. Sure. So question on just parts of the market, the S&P sectors, where we think the best returns might be, what are some of the biggest sectors. First, at a high level, I would say the S&P 500, like it or not, has become technology for the most part. Almost 50% of the index is the technology, communication services, and then adding in a few companies that are considered consumer companies, but I would say are technology companies like Amazon and Tesla. So that's by far the biggest. Our outlook there is, I would say, for the companies and the businesses is generally positive. The question is more what the stock prices, what's already embedded in those stock prices. So it's hard for me to get too detailed into predictions on returns by sector, or industry within the S&P. But I would generally say we have an improved outlook for, like you mentioned, there's parts of real estate, some financials, industrials, parts of those we think could do better than we've been experiencing. And there's other parts that we think the fundamentals could still be okay, but maybe some of the excitement wanes a little bit as other parts of the market become, a little better for the first time in a while. So I don't know if maybe that doesn't answer it specifically enough, but I'm going to go with that for now.
The question was around the large-scale investments expected to be created in the United States semiconductor industry as a result of the Science Act, as well as the Inflation Reduction Act of 22, I believe. Yes, even though that there's a different administration and a different Congress, we do very much expect a significant amount of semiconductor investment. Part of that is just because it's already been committed to. The other part is that as a result of the AI race, there's been enormous amount of commitments to foundries here in the United States in different areas, different states. Companies like Amazon under AWS and Alphabet are now very, very prominent in designing their own chips and have an interest in certainly doing as much as they possibly can in the United States. I think it's also important to remember that The AI situation is essentially a race, a war that the United States wants to win and is committed to winning. And part of that, importantly, comes along with making sure that you have your own supply and logistics lines to make that happen, and not be reliant on lines specifically out of Taiwan or other areas. John.
Yeah, I mean, I would just add, outside of semiconductors, Inflation Reduction Act, the market view, there is a view that a lot of the clean energy tax credits and that part of it could go away potentially. A lot of the stocks that have been beneficiaries of those policies have been performing really terribly in recent months since the election, basically. So that's expected. I think it's kind of priced into many of the sectors. We don't know exactly how that will go, but I think that's the expectation at this point. All right, well, we thank you all for joining us, and everyone feel free to keep enjoying some drinks and food, and we can come around and talk more one-on-one. If you have follow-up questions, find one of us. We're happy to chat more. We're happy to see you when you're in the office. It's great to see everyone. Thanks again.
Yeah, thank you.